So, good morning, everybody, and welcome to this session for doubts which are related to valuation examination. So, I request everyone who has joined the session that if you have any doubts, just post it in the chat window over here, and in that sequence, I'll start answering your doubts. Meanwhile, I have also received some doubts by email or WhatsApp yesterday and day before yesterday. So, I will start with that. I have kept it ready. So Mrinmoy Das sir has asked me, as the syllabus has changed from June 2020, can we give examination in the previous syllabus? No, sir. As the syllabus has been changed, you need to appear in the examination with new syllabus only. What is the change in the previous syllabus and recent syllabus, which is opening from 1st of June 2020? So let me tell you, there are 2-3 major changes. Some minor changes are also there. First major change is that they have removed Sales of Goods Act and Contract Act from the syllabus. Second major change is earlier case studies were worth 16 marks and there were 2 case studies only. Now the case studies are worth 20 marks and there are 3 case studies. And number 3, now you have 4 in-days in your syllabus. One related to fair valuation, one related to business combination, one related to financial instrument, and one related to impairment. And some other minor changes are also there. So this is the major change in the examination pattern. Otherwise, almost I will say 90% of the syllabus is same as before. Right, sir? I hope that answers your question. Okay, so there is one question. Can you advise the list of formulas required to be remembered from exam point of view, please? Yes, sure. I will. In fact, I have shared list of such formulas. Just give me one moment. If you have been part of one of my sessions, then I will say, okay, just a moment. So too many files are open at my end. I need to just check it. Okay, this is, no, not this one, not this one. Wait a minute, sir. I'll tell you the list of formulas, and in fact, I'll try to share those formulas also with you. Okay, so there is one file and I am posting it here, which has always been shared when I took session at your RVO. This is the file. Wait a minute. It was named as case studies for participants. Yes, it is here. So I have posted one file in the chat window itself, and it is titled as case studies for participants. And in last 2 pages, all the major formulas have been shared here with. There may be some other formulas and I'll try to address those formulas also. Okay, so now the next doubt here is, wait a minute, this is the file which I was using. It is here now. What are the books to be studied for preparing the examination? Now, as far as books to be studied for preparing the examination are concerned, I must say, there are many such books which are available. Like there is one book, Return on Valuation Examination by Vikash Goyal. You can refer that. There is one book named as Lodha. You can refer that. There is one book the author is named as B.L. Chakravarti. You can refer that. So there are many books available and almost all books are at par. You can choose any one of those books. But the benefit of Vikash Goyal and B.L. Chakravarti is that they have not only given MCQs, but also they have given, text Like if you refer to BL Chakravarti book, it also has text and then it has questions. And in the Lodha book, one of the disadvantage over there is that that the publisher has published answer in the bold letters itself. So if publisher has published answer in bold letters, so I read the question, 4 choices are given. Say answer A is correct, so answer A is published in bold letters itself. So you don't get an opportunity to apply your own mind, and that's why I don't personally prefer that type of layout. If you're comfortable, you can refer that book also. Right, sir? Okay, so Basu sir is asking, can you please tell us what are the new edition in June 20 syllabus? New edition is now you have 4 Indies, one on impairment, one on business combination, one on financial instrument, and one was already there, fair value. Contracted and sale of goods act they have removed, and case studies has the weightage of case studies has actually gone up. Earlier it was 16 marks and now it has gone up to 20 marks. And what I find is that most of the people actually find it difficult to attempt case studies. In fact, Vishal Sharma sir has asked, please suggest whether we have to first attempt case study or theoretical concept in the exam. So I'll say, sir, earlier what they were doing, earlier the paper pattern was like this. First, they were asking all single mark MCQs. And at the end, they were asking 2 or 3 case studies. But now what they do, some candidates have reported that they will give you 20-30 MCQs and then 1 case study. Then further 20-30 MCQs, then 1 case study. So the 3 case studies, they have scattered across the paper. But it's your choice. I personally think, different people, different strategy. So if I am the candidate who is going to appear in the examination, I'll first attempt all single mark MCQs and skip the case studies even if it is coming in between. And I try to finish the paper maximum in 1 hour 10 minutes, except case studies. Then I will devote, now I'm left with 50 minutes of time. So I'll give a 40 minutes time budget to case studies part. So that is 1 hour 50 minutes I will be able to finish. Then remaining 10 minutes I will give to review what I have already answered. Or in fact, 1 mark MCQs will be 80. So yes, you can do it in 1 hour or 1 hour 10 minutes and then half an hour to 40 minutes for case study and then 10 to 15 to 20 minutes time just to review your paper. Never come back before 2 hours, sit over there and review what you have answered. Probably you will be able to revise some of the questions thereafter. Okay. So, case study, what I have realized is that people usually find this case study part to be the most difficult. And now these guys have started asking more case studies and fixed income and options also. So keeping that in mind, I have also prepared one material. Probably I might have shared you in one of the WhatsApp groups. I have prepared some videos for this case studies, fixed income and option. Those videos are total 28 hours of recorded sessions are there. Earlier it was 23 hours, but looking at the latest trend, I have made supplementary video of 5 more hours. See, these videos you will watch for 28 hours, but I took 150 to 200 hours to prepare it. So everything is well researched over here. And as I said, here I have covered case studies, equity valuation, fixed income securities valuation, and option valuation. And people come from varied backgrounds. Some are already doing valuation. Some are totally non-finance people also. So I've started everything from scratch, right from the beginning. And I have tried to cover as many case studies and fixed income and option questions as possible. And one more important thing I must tell you, probably I might have told you in one of the sessions, that at some of the NISM centers, MS Excel is not available because they don't have the license for it. In that case, they make you available Apache Open Office. And this Apache Open Office spreadsheet is very similar to Excel, but there are some difference. Like in Excel function, you put commas as separator, like equal to PV, bracket open, rate, comma, number of period, comma. But in Apache Open Office, you have to put semicolon sign instead of comma. That's the difference. So I will advise, once you book a slot, visit the center, ask to them, do they have Excel or what kind of software they will give you. They will, if they are giving you free source software, download that software on your system and practice it at least for 15 minutes, 20 minutes, so that you don't get surprised when you reach the examination hall. So in this video, I have shown MS Excel, Apache Open Office, Libre Open Office, and if everything fails, then how to make calculation on calculator, ordinary calculator also I have shown. And definitely, being a recorded session, you can play this session at your own speed. One speed, 1.1, 1.2. If you're good enough, you can play it at 1.5 speed and you can save on your time. DIY style videos are this: do it yourself. I explain my question, then I say pause it, do it yourself on Excel, then again play it, and then I will show you the whole solution, and then you can match your answer. Because even if you're practicing MCQs, for example, and if you simultaneously look at the answers also, this is the question, this is the answer, question, answer. Until and unless you attempt it yourself, sir, you won't have a grip. So just try to do this. These videos are not for free. The last thing, these are subscription based, and it's not like I'm making some huge money out of it or something. If you watch the video and after watching the video, if you feel like it's not worth, ask for 100% refund. You will be given it. For details, you can contact my office, and the number is written over here. I have also posted it in the chat box. Okay, so there is one question which has been asked, and believe me, by listening to doubts of other participants also, you'll be benefited. So one doubt has been asked. In one of the ICI RVO session, there was one question number 15 in my case studies for participant sheet, and this is the detail of the question. And investment in working capital was given and net new borrowing was given as 40. And the doubt has been asked that FCFF is equal to profit after tax. Okay, now listen everybody, this is going to be useful for everyone. FCFF is profit after tax, okay, plus depreciation, fantastic. Then you add back interest multiplied by 1 minus tax rate, that's very fine. Then you deduct capex minus working capital. So we did the same thing in that question also. But why is net new borrowing of 40% not just adjusted here for FCFF? Okay. So now allow me to tell you one thing over here, that why I have not adjusted net new borrowing in calculation of FCFF. So there is one popular concept over here, and it is actually named as the circle concept. So it is here. Okay. So this is the circle concept, sir. Probably I taught it in one of your batch also. Now this circle concept says that circle number 1 is the situation where you want to calculate value of equity, and circle number 2 is the situation where you want to calculate value of the firm. So just look here, if you want to calculate value of firm, that is your following circle number 2, and free cash flow to firm is to be calculated. So the rule of thumb here is take cash flow of people outside the circle only. So if I'm trying to figure out value of firm and therefore I need to calculate free cash flow to firm, then I'm following circle 2. Now, long-term and short-term debt are inside the circle. Any cash flows related to long-term and short-term debt should be ignored. And that's why, oh, probably I have not shared the screen. I'm sorry. Okay, so I was saying we are following circle number 2. And in circle number 2, you know what happens? This long-term debt and short-term debt, they are part of the circle, and therefore any cash flow related to people who are inside the circle must be ignored. And that's why, for the purpose of, just a minute. For the purpose of calculation of FCFF, look here, we have not adjusted new borrowing. Then there may be a question from your side that why we are adjusting interest in that case. Sir, actually profit after tax is a profit after deducting interest, and we even do not want to deduct interest, and that's why to adjust it back, we have added back amount of interest. That was your question, sir. Okay, so now I'm moving towards the next one. Look here. Okay, can you explain swap practical question which might appear in our exam? From the chat window, I'm taking the question, and Girish Gupta sir is asking this. Okay, sir. As far as swap questions are concerned, let me tell you. It is here. Look. So, you know, what type of question they will ask? I cannot comment on that. But yes, what is swap? That I can quickly tell you. Especially the interest rate swap. What is interest rate swap? An interest rate swap is the swap where there are two parties, say Mr. A and Mr. B, and Mr. A promises that, say, for next 5 years, he will pay 10% interest on a notional principal of 100 crore rupees to B. So they mutually decide one notional principal, 100 crore rupees. They mutually decide one time period, say 5 years. And thereafter, A promises B that, look, buddy, at the end of each year, I will give you 100 crore into 10%, that is 10% interest. Whereas B promises that, okay, I'll give you LIBOR plus 3%. LIBOR stands for lender interbank offered rate. It's a fluctuating rate. So currently LIBOR is 7%, and suppose LIBOR plus 3% B has promised. So currently B is also promising to pay 10%, but next year if LIBOR rises to 15%, then 15 plus 3, B will be paying 18%. This is called interest rate swap, but the principal itself is not exchanged, but interest is exchanged as per the pre-arranged contract. Principal is not exchanged, that's why it is called the notional principal. So usually a swap dealer organizes a swap contract and he charges a commission. Look here, this is the swap dealer. Suppose current LIBOR is 4%, London interbank offered rate, which keeps on fluctuating. So dealer will say, I will pay LIBOR and receive 4.2%, not 4% plus 4.2%, because 20 basis point is the commission for the dealer. On the other hand, if I receive LIBOR, dealer says, I will pay 3.8%. So 4% minus 20 basis point is commission. So total 40 basis point of commission dealer will be earning in each of the year during which the swap is executed. Now suppose there is one company, ABC Limited, which comes and attaches with the dealer for the swap contract. ABC Limited has issued corporate bonds where it pays 6% interest, but later the promoters, directors of ABC Limited realizes that they don't want to pay fixed rate of interest. They want to convert their fixed rate loan into floating rate loan. So they enter into this swap contract where they will receive 3.8% fixed and pay LIBOR. So look, they are paying 6, they are receiving 3.8. Effectively, they are paying only 2.2%. On the other hand, they are paying LIBOR. So ultimately they are paying LIBOR plus 2.2%, right? Okay. So that is the type of question. You need to have basic knowledge of the swap, sir. What they may ask, they can ask anything. So Yogesh A sir has posted a private message and here he is writing, please advise us how to prepare for exam. Okay, sir. So the question here is how to prepare for exam. So my advice is, number one, whatever RVO training session you have attended, because here we have people from various batches. So in every session, faculties share their own material. So first of all, try to go through the material which has been shared by various faculties, like for company law, income tax, FEMA, SEBI guideline, Ind AS, economics, everything. Whatever material has been shared by faculties, first try to go through it because each faculty has his own experience of guiding for this session for maybe 1 year or more. So first of all, refer their material. If you feel like that the material is actually insufficient, in that case, you can actually refer some book like Vikash Goyal author book, Lodha author book, Chakravarti author book. This is your second source. Your third source for preparation can be, suppose you want to strengthen the basics of finance. So if you're a chartered accountant, then refer to CA Intermediate Financial Management Study Material provided by ICAI. At ici.org website, it is freely available for download. Just go through 1-2 chapters and your old days will be revised and your basics will be strengthened. Similarly, in CS and CMA examination at intermediate level, financial management paper is there. So if you're a company secretary or CMA, you can refer to your respective institute's material because once upon a time you might have gone through it. It will be easy for you to refer that. Now, if you want to have a more advanced preparation, say for the case studies part, which is the most crucial part, because there are 20 marks of case studies we have, right? And usually if the case study of a participant goes right now, in that case, he can score really fantastic. Similarly, now they have started asking case studies on fixed income and option also. So this case study, fixed income, option together, it is worth 30 marks. And usually a candidate, if he doesn't clear the exam, his failure is marginal by 5 marks, 7 marks, 3 marks, even by 0.25 marks sometimes. So you just need a little push. Those who want to master the case studies, fixed income and option part, for those people also, I have also prepared some videos. So I'll quickly give you highlights of those videos. I have prepared total 28 hours of videos, which comprises case studies, fixed income and option comprehensively. It will help you not only in examination, but also beyond examination when you will be practicing as a valuer. And I have covered in-depth explanation. After lockdown, whatever examination trend has been changed, I have modified these videos according to the latest trend of the exam, that what exactly they are asking, which chapters they are asking. In this videos, I have told you how to solve numericals on MS Excel. Now everybody listen carefully. At some of the NISM centers, MS Excel is not getting available. In that case, they will make you available either Apache OpenOffice or Libre OpenOffice or some other free source spreadsheet software. So be prepared for it. In fact, visit your center as soon as you book the slot and go and confirm over there that which kind of spreadsheet is available. In a rarest case, if spreadsheet is at all not available, then how to do it on calculator. In these videos, I have dealt how to do it on MS Excel, OpenOffice, Libre OpenOffice and calculator. All kind of calculation I have discussed. See, the videos are 28 hours of the time, but I have devoted more than 150 hours of time to prepare this. When you watch a 3 hours movie, it might have taken 1 year's time to make it. So for this 28 hours of video, I have devoted 100 to 200 hours of time. And this is recorded session. So you can play it at 1.5 speed if you're comfortable with the concept, 1.2 speed, 1.1 speed. You can pause it, you can repeat it. So you can learn at your own pace. This is also one great source of preparation because I have been working on this thing for last 1 year. And this video is in do-it-yourself style. Where I explain a question, then I say pause the video, do it yourself, then you play it again and match the answer. Because until and unless you practice yourself, you will never get a confidence. You know, if you get all MCQs also with answers and you directly look at the answer, believe me, your preparation level will not be good. Attempt it yourself, then check the answer. That is always the right approach. I guess these videos are not free of cost. Some subscription thing is there, so you need to subscribe for it. But yes, even after watching it 100%, if you're not happy, you can ask for 100% refund. That's not an issue because earning money is not an objective. Helping fellow members is the objective of these videos. And if you have any query on this, what are further details? This is number of my staff, 98279 10983. You can connect to him by text, etc. He'll give you further detail. This is also one of the source of preparation, sir. And here I can kind of guarantee your satisfaction. Okay, so now the next question. So last question I addressed was how to prepare for exam. Okay. Girish Gupta sir is asking, also bond valuation on quarterly basis compounding is a problem. Do you have any formula for that? Now that's a fantastic question. That how to handle the quarterly compounding situation in case of bond valuation. Okay, let's quickly create one example. So suppose a bond is having a face value of ₹1,000 and coupon of 12%, which is paid quarterly. Quarterly coupon of 12% and maturity is say 5 years. And suppose YTM on this bond is 10% per annum. And you have to make valuation of the bond. Right, Girish sir? You know, when I'm solving somebody's doubt,
yes,
and
sir.
you have, okay, yeah. So when I'm solving somebody's doubt and you have, you need further explanation, you can always use your voice for asking further explanation on that. Just feel free to have a dialogue. Now I want to make valuation. So I will use simple that PV formula, nothing special I will be using. I'll use PV formula. When I use PV formula, first thing it asks me is discounting rate. So rather than taking 10% as the discounting rate, I'll take 10% divided by 4 because there are 4 quarters in a year. 10% divided by 4 will be my discounting rate. Number of period, 5 years multiplied by 4, 4 quarters in a year. So in 5 years, there will be 20 quarters. PMT, so one interest payment by the company will be 120 rupees divided by 4, which is 30 rupees. Company will keep on paying 30 rupees at the end of each quarter. Yes. And then FV, which is 1,000 rupees. So look here. This is how we can solve the quarterly compounding thing, sir. Right, sir?
Yes, sir. Yes, sir.
Oh, thank you. Okay. Geeta ma'am has asked, please explain valuation of preference share. Okay, sure, ma'am. So as far as examination, you know, life poses a different problem. But as far as examination is concerned, valuation of preference shares is quite simple thing. Suppose a company has issued 1,000 rupees of preference share on which it has promised to pay 11% dividend. So company will be paying 11% means 110 rupees. I'm sorry. 110 rupees company will keep on paying. And in the last year, so valuation of preference share is just like valuation of debentures. 1,000 plus 110. So that way, these are the payments by company on preference shares. Let me create here the title preference shares. So suppose investors are expecting just 10% return. I can use NPV formula. I can say 10% is the return, and these are the payments which are made by company. And I'm discounting these cash flows at the rate of 10%. I press enter and see here, this is value of the preference share. So Geeta ma'am, is that clear?
Sir.
Okay.
Sir, अगर irredeemable preference shares हो तो, if they are irredeemable.
Okay. If the preference shares are irredeemable, in that case, the present value of perpetuity formula will be used, which is like E divided by R. So suppose company is paying a dividend of 110 rupees forever. An investor has expectation of 10% return. So I'll simply say 110 divided by 10%. So 1100 rupees will be the valuation. And this is the formula. Present value of perpetuity is equal to A upon R. Himanshu ji is saying I had emailed out yesterday evening. Yes. So I'll take emailed out once again. So one more doubt in the email doubt was like this. I have confusion in levered and unlevered beta. In some questions, debt equity ratio is treated as debt upon equity, and in some question they treat it as debt upon debt plus equity. Now, yes, sir, that's the problem. You know, ratio analysis is more an art and less a science. Ratio analysis is more an art and lesser science. So when I say debt equity ratio, it can be either debt upon equity or it can be debt upon debt plus equity. But you know, debt upon debt plus equity should be better named as, what should I say? It is debt to value ratio and not exactly the debt to equity ratio. So you need to be careful, and it is the duty of the question maker to give an explanation that, you know, when somebody says debt equity ratio, I'll simply assume it to be debt upon equity. If they want me to interpret it as debt upon debt plus equity, they need to clearly tell it in the formula. Right, sir? So swap part we have already discussed. Okay. Okay. Good morning, sir. Looking forward to the session. Yes, sir. Good morning. And Achintya sir has asked, I have attended the module in June 2019 and had some attempts so far in September 19. Thereafter, I have not attended any exam. Is there any syllabus or structure change? Do I have to do 50 hours module again? No, sir. You don't have to do 50 hours training again. But yes, there are changes in examination, and I have already addressed that. And the thing here is that 4 index are there, contract and the sale of goods site has been removed, case study part has gone up to 20 marks. Otherwise, the basic structure of the course is same. So you just go ahead with a proper preparation and definitely you'll be able to clear it. Good morning, sir. Good morning, everybody. Yes, definitely. Whatever I am typing on a Word or Excel file, I can share it. There is not an issue. Okay, Suresh Jain sir has asked me whether we have to learn both problem of Black-Scholes model and binomial model, or can we omit Black-Scholes model because it is taking more time for examination. Sir, actually, they won't expect you to solve a question on the Black-Scholes model. You go through at least assumptions which are used in Black-Scholes model, and probably that part only will be enough. Okay, just give me one moment. I will open one file for you. It's here. Just a moment. I'll let you know that how to approach Black-Scholes model. You know, if you can practice a question on Black-Scholes model, that is the fantastic thing. Nothing better can happen beyond that. But if you don't have time to practice Black-Scholes model, then here is my advice. It's like this. So, you know, at least you go through assumptions of Black-Scholes model. If you want to make valuation of European options, one should use Black-Scholes model. If you want to make valuation of American options, then one should make use of binomial pricing model. But if you want to make valuation of more complex options like Asian options, then you should use Monte Carlo simulation. At least first of all, you should know this. They may ask you 1 mark MCQ on the particular thing. Now, as far as Black-Scholes model is concerned, there are several assumptions like 1, 2, 3, 4, 5, 6. Even if you Google it, models, assumptions of Black-Scholes model, you'll get all those assumptions. At least you should have an idea about the assumptions of Black-Scholes models. Even if you're not able to do numericals, you just need to have a gross rough idea. And especially this table, that what is the effect of change in various items on the option premium. What if the market price of share increases? What if strike price increases? What if risk-free rate of return increases? Time to expiry increases? Volatility increases? Dividend increases? Black-Scholes does not consider dividend, but Black-Scholes and Melton, it considers dividend also. So these fundamental things you need to know, and don't bother about this difficult formula. Right, sir? Okay, so Mohan sir is asking, I took my first attempt last Friday and missed by 0.75. Oh my God. That's so sad, sir. I realize your advice for attempting only 75 to 79 question. Can you repeat this advice once again? I would have passed if I have not left at least 3 questions which I would have answered incorrectly. Okay, so on attempting questions, look, sir, my opinion here is different from what other faculties or what other participants feel like. I personally have a different strategy. My strategy is that if you are damn sure about the question, you must attempt it. If you are 100% unsure that what is the right answer of this question, leave that question. If the question is absurd, that is, they have given you 4 choices and none of the choice is the answer, then also leave the question. But if you are in a 50-50 kind of situation, that this question, I'm not quite sure, but out of 4, 2 choices I'm able to rule out, and now I'm confused among between remaining 2 choices. In that case, even if you don't know akkada bakkada bambe bo 80 90 pure, so go for it, because getting the right answer probability is 50% and penalty for wrong attempt is just 25%. And sometimes, you know what happens, you are confident that I attempted this right, but maybe that one is wrong, and here you are doubtful that whether it is right or not, and you attempt it and it goes right. Okay, if you're totally blank, leave the question. But if you have some doubt, then better to go and attempt that question. That's my personal opinion. Okay, Suresh Jensen is asking whether we have to learn the problems of put call parity for our examination. Okay, now that's a good question, sir. Put call parity can be used. Let me quickly show you the formula for put call parity equation. Just give me one moment and I'll share a different file. Maybe this one. So put call parity, okay. So equation here is minus VC plus VP is equal to minus VS plus present value of strike price. Now, what does it mean, sir? Suppose value of call option is 10 rupees. Suppose value of put option is not known to you. Suppose value of stock is 100 rupees. Okay. And suppose present value of strike price is 95 rupees. So when I solve it, it will be like this. It is minus 5, right? So it will be VP is equal to 10 minus 5, that is equal to 5 rupees. So just keep in mind, you need to mug up this equation. Value of call, value of put, value of stock, present value of strike price. These 4 items you need to keep in mind. And if you know any 3 item out of these 4 items, then you can make calculation of the balancing 4th item. This is called put call parity equation. So better to mug up this, and it's not very difficult, you know, minus sign, plus sign, minus sign, plus sign. On left hand side, you have call option as well as put option. On right hand side, you have value of stock and strike price. So that way it's not difficult, and you know, you can easily attempt it. So I'll advise you to attempt it, sir. Okay. So a few more doubts have been posted. I would quickly answer now. File not received. Okay, I'll try to share it later. Dear sir, would you please throw some light on the what kind of valuation are mandatory to be done by registered valuer vis-a-vis through merchant banker? Okay, so Sandeep sir, look, under Companies Act, any valuation, if it is mandatory under Companies Act, then it must be done by a registered valuer. If valuation is compulsory under Companies Act, then it must be done by a registered valuer only, full stop. But if I talk about Foreign Exchange Management Act, then Foreign Exchange Management Act does not mention merchant registered valuer. It says either a chartered accountant can make valuation, or CMA can make valuation, or merchant banker can make a valuation. So if you are a chartered accountant plus registered valuer, that's an advantage. You can make valuation under FEMA also. Under Income Tax Act, if the valuation is to be done on book value method, then no certification is required. But if the valuation is to be done on DCF method, discounted cash flow technique, in that case, it must be compulsorily done by the merchant banker and not by the registered valuer. Sandeep sir is asking, would you please throw some light on what kind of, okay. Shiv Prasad sir is asking, file is yet to be shared. Okay, I have posted the file, but if you have not received it, then let me do one thing. I will give you one Google Drive link. And once this session is over, and then I'll get free time, and I will post thereafter every stuff here. So I'm naming it as untitled folder. Where is my folder? Okay. So I'm giving you link of one folder. Just a minute. Okay, sir, you have not received file, no issue. That file has been shared many times in various RVO sessions. Still, if you need it, I have posted here one link. As soon as I get time, I'll post stuff in this link. Don't worry. Not now. As of now, if you will see, you'll find the folder to be empty, but you will later you can download it from there, sir. Okay. Loda is fifth, fourth and fifth edition, no bold letter answer. Okay, that's good. That's good. Then why are we deducting interest? Okay, Charuji, we were not deducting interest. We were adding back interest in that particular problem. We started with profit after tax. We wanted to calculate free cash flow to firm. I'm repeating, if I'm discussing any particular question and you have doubt in that question, ask by your voice immediately, because otherwise you will post it and it will come after 5-10 questions. So we started with profit after tax. Profit after tax was after deducting interest, and we never wanted to deduct interest, and that's why to correct it we added back interest. Circle number 2 concept, right, Charuji? Sandeep sir has posted a private message. Could you please throw some light on what kind of valuations are mandatory? Okay, this I have answered. Anjali ji is saying, please discuss model paper numerical questions. Okay, now model paper numerical questions are too lengthy to discuss. If at the end of the session, if I get some time, then I'll try to discuss it. If you have been part of one of my sessions, then in all case studies, like one case study where company has sustained a loss, but after removing the abnormal loss, there is a EBIT of 5693 crore. That question is the model paper question itself, and I have solved it in almost all sessions. Still, at the end of the session, I'll try to take that, sir. If interest on FD and gold bond rate given, which rate to be taken as risk-free rate? Now that's a good question, Aditya ji. Interest on FD should not be taken as the risk-free rate of return. Gold bond return should not be taken as the risk-free rate of return. Only 10-year government of India bond, 10-year means a long period government of India bond return, should be taken as the risk-free rate of return in India. If they have also given short-term treasury bill rate of return, that should also be ignored. That is not the risk-free rate of return. Is it clear, sir?
So if only these two is provided, then which one to be taken?
Sorry.
Only if these two rate is given in the question, risk-free rate and the bond rate and the gold rate, FD rate and the gold rate is given, then which one will be taken?
Okay, only two rates are given. You want to say
Yes,
that?
yes.
Okay, in that case, we'll have to take FD rate, because FDs like SBI, FDs are almost risk-free, not exactly, but you can take FD rate.
So in my thought, both are risk-free. The rate which are higher to be taken, that is not correct?
No, sir. No. So gold bond is a different thing, because gold bond return indicates only inflation. Gold is a commodity. An increase in price of the commodity is nothing but inflation. So
okay,
that will cover only inflation part, while the FD will cover inflation, compensation for deferment of consumption also. So FD rate will be better than the gold bond rate.
Okay, thank you.
Most welcome, sir. Okay. We have to take CP 4% and year as 20. Suresh Jain sir, can you please give more information on this? I'm not getting this question. We have to take CP 4%, coupon 4% in year 20. Is it your question? Okay. Achintya sir is saying regarding Ind AS, can you explain what are new inclusions? I have already told you earlier, only Ind AS 113 was there. Now they have 4 Ind AS, one on financial instrument, one on business combination, one on impairment, and 113 is still there. Do we need to study all international valuation standard for examination purpose? No, sir. Mohan Kumar sir, not at all. You need not to study ICI valuation standard. You need not to study international valuation standards, because valuation standards are not part of your syllabus. As far as examination is concerned, I'll tell you something interesting. When I started preparing for this examination, I was not aware. So before 50 hours of training, I gone through the entire ICI valuation standard of 100 pages. And on the very first day, our faculty told us that this is not part of syllabus. But I don't have a regret for it, because sooner or later you will have to study valuation standards also as a practitioner. And once you study valuation standard, even from the examination point of view, your grip on the subject will become strong. So if you study it, that's fine, but it's not part of syllabus.
But there was a question, Tarunji, on IVS 109.
Oh, in examination, they asked it.
Examination, yeah.
Okay, so in that case, on the safer side, you can at least have an idea that in what is given in what IVS. But that exactly is not part of syllabus, sir.
Thank you.
Right, sir. Please explain control premium and discount. Oh, sure. I will explain that, sir. Just give me one moment. I need to open one correct file for the same. Fixed income. This is. Okay. So now let's talk about control premium and discount. So it's here. So Suresh sir, here it is, answer for your question. Look, how to adjust, in what situation to adjust control premium and discount and liquidity premium and discount. First, let's talk about liquidity premium and discount. Say I'm making valuation of an unlisted company and I'm using the market multiple approach. So what do? I find a comparable listed company, and comparable listed company has a price earning ratio of 20 times. While my earning is 10 rupees. So my earning 10 rupees multiplied by P ratio of listed company 20 times, that is 200 rupees should be the fair value for my share. This is how it happens, right? But I am comparing with a listed company where the shares investments are liquid. And that's why I need to deduct discount for lack of marketability, discount for lack of liquidity. So if you are making valuation of unlisted company, by comparing it to a listed company, you need to deduct discount for lack of marketability, D-long. But if you are making valuation of unlisted company on the basis of other unlisted company, say especially in case of startups, I am making valuation of one startup where I have started making a sale of 1 crore rupees per annum, and there is another similar startup, and there has been, that startup has got a funding recently at price to sales ratio of 5 times. So my sales is 1 crore and 5 times, so my valuation should be 5 crore rupees. Now that startup is also unlisted company. My company is also unlisted company. So unlisted to unlisted company comparison I am making, it means the discount for lack of marketability has already been adjusted in their price. Hence it is already adjusted in their ratio. Hence I need not to make any further adjustment for it. This is discount for lack of marketability. Now let's talk about discount for lack of control. So again, or control premium, vice versa. So again, my company is unlisted. I compare with a listed public company. Their price earning ratio is 20 times. How do I calculate price earning ratio of comparable listed company? I take their market price per share divided by earning per share. Now look, their market price per share. How come their market price per share? Because some people are trading share in this company on daily basis. Promoter is holding 75% shares in the company. Public is holding 25% shares, and out of the public, some big investors are there. So hardly 5-10% of the shares come to the market and they are traded. It means minority shareholding is trading shares, and that's why the market price per share of the comparable company is reflecting the price for minority shareholding. And if I take their P ratio and use it for my value calculation, it means that whatever value I derive, that will be the value of minority interest. While I am going to acquire majority stake in the unlisted company, so I need to add control premium to it to arrive at a fair value. Now this control premium can be of two types. It can be a financial control, it can be a strategic control. Suppose now let's take example of cash flow method rather than the market multiple method. Suppose I am using free cash flow to firm for the purpose of valuation, then the value I arrive at already includes financial control value. I'm using free cash flow to the whole firm. It means whole firm is in my control. I'm indirectly assuming that. So when you are using FCFF, FCFE for the purpose of valuation, the control premium is already included. If you want to acquire minority stake after making this valuation, then you need to deduct discount for lack of control. On the other hand, I'm taking not only free cash flow, but I'm also taking some synergistic benefit. If that company and my company, if Facebook and Reliance Jio, if they work together, then 2 plus 2 will not be 4, 2 plus 2 will become 5, or it will become 22. So if I'm considering those synergistic benefits also in free cash flow, then I'm getting a value which includes not only control premium for financial control, but also control premium for strategic control. So this is about control premium, an opposite word, discount for lack of control, and liquidity premium, an opposite word is discount for lack of marketability. Okay, Sandeep sir, probably that answers your question. Anjali ma'am is asking, sir, please discuss module question. Okay, I told you, ma'am, if time allows, I will discuss that. Okay, probably. Please explain control premium discount. Will Competition Act be applicable? We can simply check the syllabus and quickly see whether the Competition Act, when you are studying business merger and acquisition, there I refer some part of competition, but let me, at IBBI website, you can anytime check the details of syllabus and give me one moment. It doesn't look like. I'm not able to find it, whether competition is part of your syllabus or not. As far as my knowledge is concerned, it is not part of your syllabus. There was a case study on Black and Scholes model in exam. Okay, I seriously doubt it. But if they ask you a case study on Black and Scholes in exam, then definitely you need to learn it, how to do the Black and Scholes question on MS Excel. And then you will have to learn the formula. Nobody ever told me, sir. So, Prateek sir, if you come across, just drop me one personal message on WhatsApp, and later I will discuss that whether you got this case study in the exam or any of your friends got in this exam. And I would like to talk to that fellow that what exactly was the type of case study. Any problem on Monte Carlo model of option? Suresh Jain sir, Monte Carlo model simulation questions they cannot ask. They will ask you only consent, because for Monte Carlo simulation, you need special software. Even MS Excel is not capable of doing that. You need special software which are to be attached to MS Excel, and then only it works. So they will ask you only theory concept on Monte Carlo. They won't ask you numerical. Mandeep Singh sir is asking in the FEMDA section guideline towards description of derivative, please give the guideline number. I'm not really aware that what FEMDA guidelines are saying, about derivatives. FEMDA guidelines, what they are saying about valuation of fixed income securities, that you can refer to. But if you have any specific question on, because FEMDA guidelines are huge, so I'll advise you to personally drop me on WhatsApp that particular guideline, and then I'll be able to throw some light on it. Any textbook which explain Black-Scholes, binomial and Monte Carlo simulation from a real world option valuation perspective. Real world option valuation perspective you will not get in any of the books, sir. As far as examination perspective is concerned, Black-Scholes binomials are discussed in detail in my videos, but real world perspective, no such book is there. You'll have to Google it. Shiv Prasad sir is asking if current value of put is 137 and actual price is put is 110. Strategy would have overvalued, undervalued, sell back. Okay, fantastic, sir. Current value is 137. When I say current value, probably you are saying the ideal price is 137 and actual price is 110. See, the ideal price is 137. Actual price is just 110. So actual price is less. So I'll say put is undervalued. And if the put is undervalued, I should buy the put option, sir. Is it clear, Shiv Prasad, sir?
Yes, sir. Yes, sir.
Okay, thank you. Geeta ji is asking, when Excel is not given, how to do big problem, which has only... Geeta ji, in that case, they will make you available open office, like Libre open office or Apache open office. Use that. Don't worry about it. And I told you in my videos, I have given calculator short tricks also that are taught to students of CA final, CMA final, CS final. But that is the rare possibility is there for that. Anjali ma'am is asking, do we have to study Walter, Modigliani, dividend growth model, or just growth model is enough? No, Anjali madam. You need not to study Walter and Modigliani and Miller approach for dividend. Just growth model is enough.
Whether rights issue is
sorry, volume is very low. Please, can you speak loudly?
whether if a company issue rights issue, is it required valuation?
No, sir. If you are making right issue of shares, no valuation is required. No certification of valuation is required. At what price they want to issue, they can come up with the issue. There is no problem at all.
Is there any circular on it or something?
No, sir. Section 62, subsection 1 clearly mentions it. So it is only in case of preferential allotment. Sometimes people say we are allotting share to promoters only. So there are two promoters, A and B, and both are holding, 5 lakh shares in the company. Now you are coming up with the right issue where you are giving further 10 lakh shares you are giving. To A, you are giving 3 lakh. To B, you are giving 7 lakh. This is not right issue. Because even if the shareholders are same and their proportion is changing, in that situation also it is not a right issue, it is a preferential allotment of securities, and in that case valuation is required. Section 62 subsection 1 of the Companies Act clearly mentions that valuation, along with rules when you read it, that valuation is required only in case of a preferential allotment and not in case of right issue. Right. Most welcome, sir. Okay, now international valuation I have answered. Whether valuation is required if company issue right issue. Private company issuing ESOP. So for ESOP accounting, they need to do ESOP valuation. In that process, they need share valuation of company on grant date. This need to be done by RVO and CA can, no sir. ESOP valuation can be done only by the registered valuer. Because ESOP is under the Companies Act, and under Companies Act, wherever valuation is required, it must be done by the registered valuer. But probably you are talking about the vesting date. So for the sake of accounting, it is always better to be valued by the registered valuer only.
Sir, I am talking about on the grant date, we require the share valuation also. So there are 2 points. One is the share valuation, another is the ESOP valuation.
For tax purpose, right?
No, sir, not for tax purpose, only for the accounting purpose. For grant date, we require to do the accounting as per the guidance note for the fair valuation accounting under the Ind AS.
Okay, so for accounting purpose.
Yeah, accounting purpose only.
For accounting purpose, sir, valuation, there is no clarity, but you know, practically people are preferring registered valuers only. Like Ind AS, under Ind AS you need fair value, but
Right,
they
sir,
have
right.
never mentioned that registered valuer should only do it. But all the big companies, they have started कि नहीं भाई valuation होगा, so it must be done by the registered valuer, though there is no such specific requirement.
Okay.
Right?
Fine.
Okay.
And that underlying share price also need to be determined by RVO.
Yes,
Because,
yes.
yeah.
It's better, sir. It's better.
Okay.
Yeah.
Thank you.
Most welcome, sir. Chaya ji is asking how to determine RM in question at times premium is given, at time market return is given, whether it will be okay. So when they want to say RM, they will say market return is 15%. When they want to say RM minus RF, they will say market risk premium is 6%. That is the difference between market return and market risk premium. Difference between market return and market risk premium is like this. Market return is RM, market risk premium is RM minus RF. Is that clear, Chayaji? Okay. How to solve option valuation question? Life of stock index is 5,000 every month, probability to goes up 20%. Okay. So Asim sir, that is basically the question you are asking. Many people are asking it. That question is basically the question on binomial pricing model. And it's not a simple binomial model. It's a 3-step binomial tree. 1 step, 2 step, 3 step. And the question is defective also because it has not given the risk-free rate of return. But discussing it over here, it's quite lengthy exercise. It's a binomial option pricing model, that 2 with 3 steps. So I don't know how to explain that, because the question they have asked once in the examination, that was the defective question, and if they give the right question, I need to take at least 1 hour just to explain that question. And then you practice it and master it, and then only you will be able to solve it. In my video, I have tried to cover it, but here it will be quite lengthy to discuss. But yes, let me give you one hint. It can be solved with binomial option pricing model, and that too with not the regular binomial model, but with the binomial tree. And you will have to make a 3-step binomial tree. And they have not given risk-free rate of return in that question. So you can assume it to be 0, and then you can solve it accordingly. Okay, Mohan sir is asking, how do we compute weighted average cost of capital when there is no tax rate given for debt? In that case, sir, interest rate itself will be assumed as the cost of debt. Suppose YTM or interest rate is 10%, tax rate is not given. So interest rate itself will be assumed as cost of debt, and then we will proceed to calculate weighted average cost of capital. Rakesh Jain sir is asking, if a firm has P ratio of 15 and return on equity of 14%, what is market value to book value of equity? Okay, now that's a nice question. So let me answer it. I will share one file, maybe this one. Look, so that's your question. So let me tell you the formula for return on equity. Return on equity formula is like this: earning available to equity shareholder divided by equity shareholders fund. Okay. Now, if I divide it by number of shares in the numerator as well as in the denominator, I can do that. Divide it in numerator as well as denominator. It will become earning per share upon book value per share. You know, earning available to equity shareholder divided by number of equity share is earning per share. And equity shareholders fund divided by number of equity share is book value per share. So now in this question, you see ROE is 14%, 0.14. And this is equal to PE ratio is given as 15 times. What is market value to book value ratio? Okay, you want to calculate market price per share on book value per share. Now, what is market price? If I divide market price per share by EPS, and I also divide book value per share by EPS. If I divide both numerator and denominator with the same number, the result will be same. So market price per share upon earning per share is the price earning ratio. It is 15 times. Now here, just a minute, EPS upon BVPS. It's like this, 0.14. Okay. So what do I do here? I need BVPS upon EPS. If I inverse it, BVPS upon EPS, it will become 1 divided by 0.14. EPS upon BVPS is 0.14. So BVPS upon EPS will be 1 upon 1.14. So this will be 1 divided by 0.14. When I further solve it, it will become 15 multiplied by 0.14. Calculator, okay. My screen is shared probably, no? Oh yes, it is. Just a minute. I need a calculator. It's here. It's 15 into 0.14. That's 2.1. So this is the answer, sir. Very good question. On ratio analysis, it's a good question, I must say. Right, sir?
Yes,
Rakesh, sir?
Yes, sir.
Does it answer your question?
Yes, sir. Thanks.
Okay.
But in IBBA exam paper, it's saying something different, sir. Actually, that was the confusion only.
So 2.1 was not one of the choices?
No, it's not there, sir. That was the only. There was 1.5 was the right answer.
Okay, the model paper you are saying.
Yes, sir. Yes, sir.
No, in that case, the model paper is wrong, I must say.
Thank you.
Okay. It is not there in syllabus. Many people are saying CFA model is good for problem. Is it correct? Yes, definitely. International CFA is such a big examination in the area of the finance. But believe me, you usually don't get a time. So much of the material, at least 5-10 authors of books is available. CFA material is huge, which is available. So if you can study all those stuff, it's really good. I must say that. But usually you don't get that much time to study. That's the problem. Okay. Yes, sir. On BSM model, videos are available. Many videos are available. You can learn it over there. What is difference between Excel and spreadsheet? So Suresh Jain, sir, any spreadsheet, like, you know, when Windows was not there and DOS based systems were there, disk operating system, there was one spreadsheet which was named as Lotus 123. Then come Windows and the MS Excel became popular. Any spreadsheet which gives you calculation opportunity is the spreadsheet. MS Excel is one of the finest spreadsheet available. Apache OpenOffice and Libre OpenOffice are also the spreadsheet. Please explain Macaulay's duration. Okay, that's the lengthy thing, but still I'll try to explain that to you. Macaulay's duration. Okay, Macaulay's duration is here. Oh, okay, probably I'll have to give one example for Macaulay's duration. That will be the better idea. So here we go. Macaulay's duration. Suppose a company has issued 4 years of bond, which pays 100 rupees of coupon every year, and then 1000 rupees as the redemption price. Suppose YTM is also 10%, and I want to calculate fair value of the bond. So I'll be using YTM as the discounting rate, and our usual present value calculation formula I'll be using, and then I make a sum. Rate, number of period, comma. Then I make a sum total. So see, the coupon is 10% and redemption YTM is also 10%. That's why the bond is valued at par. Now what is duration? Duration is nothing but weighted average of the time. Anjali ma'am, what is duration? It is nothing but weighted average of the time. If year is represented by T, and you know this PV is represented by weight. So I'm calculating weighted average of 1, 2, 3, 4, where the weight assigned is 90, 82, 75 and 751. So I'll do T multiplied by W. So this is T multiplied by W. And then I copy it down. Control 1, number format. Okay. And then I make a sum total of it. How do I calculate weighted average? That's very simple. For weighted average, T into WT in the numerator and summation of weight in the denominator. And look here. This is duration. So if you're asking what is Macaulay's duration, it is nothing but weighted average of the time. Does that answer your question, Anjali ma'am? Sir, when the rate of return is not given, you're asking it for which question, sir? When the rate of return is not given? 2.1, same question in IBBI exam, but there is 1.5, 2.1 is the answer. Where do we get this model paper? IBBI model papers are available on the IBBI website itself. It was asking about what was MPS in same question. It was asking about what was MPS in the same question. MPS you can calculate only if price earning ratio along with EPS is given. Either you need to know book value per share or you need to know EPS, then only you will be able to calculate MPS, otherwise not. IVS, as I answered it earlier, sir, IVS is not required to be studied, but one of the participants is saying they have asked one question. So I don't think for examination purpose you need to study it. You just need to know the number, that there are 5, 6, 10 IVS and this number is for this number is for that. Full stop. Please explain modified duration also. Okay, sure. So modified duration is very simple. Modified duration is simply duration divided by 1 plus YTM. So I take duration and divide it by 1 plus 10%. So modified duration is 3.169 years. And you know what does it mean, 3.169 years? It means that if YTM increases by 1%, bond price for this bond will reduce by 3.17%. If YTM increases by 10%, the bond price will reduce by 31.69%. Suresh Jain sir, all functions of Excel are also available in Apache OpenOffice, with only difference like here in Excel you write equal to PV rate 10%, then you put a separator as comma. In Apache OpenOffice, instead of comma, you need to type semicolon like this. So that's the only difference between Excel and Apache OpenOffice. Intangible asset. What do you want to ask about intangible assets, sir? Okay, Suresh Jain sir is asking calculation of modified duration when the year is semi-yearly or quarterly. Sir, modified duration when year is semi. It is very simple, sir. Say this is not year, this is half year. This is half year. So half yearly company is paying 100 rupees. It means actually it is 20% coupon rate. And YTM is also 20%, but for the half year it is 10%. So the whole process will remain same. But the answer 3.49 will not be years. Whole process will remain exactly same for half years, quarter, month. But if you're inputting everything in terms of half years, you'll get answer also in terms of half year. So this is 3.49 half years. So if you want to calculate number of years, it will be 3.49 divided by 2, which is 1.74. And similar stuff you can do for modified duration also. Got it, Suresh sir? With respect to interview, is IVS is important. Sir, examination point of view, IVS are not important. But from real life point of view, you can study IVS, you can study ICI valuation standards also. Both are fruitful. Fruitful for your understanding. Arvind Jain sir, it is there in Apache OpenOffice. I have uninstalled it. Earlier I was having it. It is there in Apache OpenOffice, sir. I'm quite sure about it. You just need to type equal to PV Apache OpenOffice. Yes, it is there. Just check it properly and you'll get it. Okay, sir. So, okay, so this is all about exam preparation strategy. Probably you joined it late, sir. So I will again repeat it quickly. For 50 hours of the training, after 50 hours of the training for exam preparation, you need to again give at least 50 hours of quality study at your home. Too much of the material is circulating in the market. Too much of the material. 4 or 5 authors of books are there. CF Institute study material is there. ICSI soft copy, ICMAI RVO soft copy, ICI RVO hard copy is there. Material shared by faculties is there. Too much of the things are there. So you need to select few only. This is the first thing. Like if you are ICI RVO participant, then there are MCQs available on their LMS, Learning Management System portal. You can attempt that only and that will be enough to practice. On my mobile app also. So I have got one mobile app which is named as FM by TM. It is Financial Management by Tarun Mahajan. It is only for Android phone. not for Apple. So when you install this from the Play Store, FM by TM, then you need to, I'm telling you one more source, then you need to sign up. There is one great free source. Once you sign up, OTP issue is there. OTP issue is there. You will be verified within 24 hours from backend. Then you can directly sign into the app. In left menu of the app, you will find MCQ test. In MCQ test, you will find a folder valuation. In valuation folder, I have put around, around 1,000 questions, like 6-7 full test papers, 6-7 finance related test paper. And those MCQ tests are available to free for anybody and everybody. You can access that for that also. That is one of the source. And as you joined late, I will quickly tell you that I have prepared some fantastic videos. I lost that PPT. Where is this? This is here, the PPT. So those are also very, very, very much helpful, because for this 28 hours of video, I have divided 200 hours of the time I have devoted. You can subscribe it and it's going to be wonderful. If you want to see the demo for the same, demo is available everywhere. I can give you demo link also. So that can be a kind of very good source of preparation for you. Demo link I will share, don't worry. Rakesh Jansar is asking, TV is 80 lakhs. Yes. ROI is 10 times. Additional investment is 1 lakh. What will be post-money valuation and pre-money valuation? Okay. Rakesh Jansar, can you help me with your voice also? TV stands for terminal value?
Terminal value, sir. Terminal.
Okay. Terminal value is 80 lakhs. ROI is 10 times. That is, you want to get, okay. This is the startup valuation question. Got it. So, at the end, 80 lakh is the terminal value. You want your money to become 10 times. So 80 lakhs divided by 10 times. So current value is just 8 lakhs. But this current 8 lakh value is the post money value. And you are making investment of 1 lakh rupees. So 8 lakh rupees is the current value minus 1 lakh rupees is the investment. So pre-money value will be 7 lakh rupees.
So post money will be 8 lakhs, sir.
Yes, post money. Post money is 8 lakh, na? Because suppose after 5 years, this startup can be sold for 80 lakh rupees. And you want to make 10 times of, you want to make your money 10 times. So 80 lakh divided by 10 times, it means it should be worth 8 lakh today, then only it will become 80 lakh worth at some point of time. So if it is worth 8 lakh today, that is post money valuation.
Yes.
And that's why the pre-money valuation will be 8 lakh minus 1 lakh, that will be 7 lakh. Right, sir?
Thank you.
Okay. So that demo link, just give me one moment and I will give you that demo link also. It is there. I have posted it in many groups, but not now. Just a second. So it is here now. Wait a minute. This is the demo link for the videos I have prepared. You can watch it. FIMDA guidelines with respect to derivative definition. Sir, you need to share it with me because I have FIMDA guidelines with respect to fixed income valuation. Please do share it with me, post it on my WhatsApp, and then I'll just look at it because everything is available at FIMDA website and a whole lot of guidelines are there, and I'm not really sure that what guidelines you're asking about. So once you post it on my WhatsApp, I'll reply to you privately there only. All right, I hope that serves the purpose of everybody, and wish you all the best for your upcoming examination. And even after the examination, when you become a registered valuer, and I'm sure you will soon become a registered valuer, once you become a registered valuer and in any of your assignment, if you're stuck anywhere, just feel free to connect to me, and I'm always there to help you for the same, right? And even if you feel someday like we can jointly do something, I'll be more than happy to serve you in that manner also. All right, bye-bye then. All the best. Thank you. Most welcome everybody. Okay, so Basu sir is asking, can you please tell us what are the new edition in June 20 syllabus? New edition is now you have 4 indices, one on impairment, one on business combination, one on financial instrument, and one was already there, fair value. Contracted and sale of goods act they have removed, and case studies has the weightage of case studies has actually gone up. Earlier it was 16 marks, and now it has gone up to 20 marks. And what I find is that most of the people actually find it difficult to attempt case studies. In fact, Vishal Sharma sir has asked, please suggest whether we have to first attempt case study or theoretical concept in the exam. So I'll say, sir, earlier what they were doing, earlier the paper pattern was like this. First they were asking all single mark MCQs, and at the end they were asking 2 or 3 case studies. But now what they do, some candidates have reported that they will give you 20-30 MCQs and then 1 case study. Then further 20-30 MCQs, then 1 case study. So the 3 case studies they have scattered across the paper. But it's your choice. I personally think, different people, different strategy. So if I am the candidate who is going to appear in the examination, I'll first attend all single mark MCQs and skip the case studies even if it is coming in between. And I'll try to finish the paper maximum in 1 hour 10 minutes, except case studies. Then I will devote, now I'm left with 50 minutes of time. So I'll give a 40 minutes time budget to case studies part. So that is 1 hour 50 minutes I will be able to finish. Then remaining 10 minutes I will give to review what I have already answered. Or in fact, 1 mark MCQs will be 80. So yes, you can do it in 1 hour or 1 hour 10 minutes, and then half an hour to 40 minutes for case study, and then 10 to 15 to 20 minutes time just to review your paper. Never come back before 2 hours, sit over there and review what you have answered. Probably you will be able to revise some of the questions thereafter. Okay. So, case study, what I have realized is that people usually find this case study part to be the most difficult. And now these guys have started asking more case studies and fixed income and options also. So keeping that in mind, I have also prepared one material. Probably I might have shared you in one of the WhatsApp groups. I have prepared some videos for this case studies, fixed income and option. Those videos are total 28 hours of recorded sessions are there. Earlier it was 23 hours, but looking at the latest trend, I have made supplementary video of 5 more hours. See, these videos you will watch for 28 hours, but I took 150 to 200 hours to prepare it. So everything is well researched over here. And as I said, here I have covered case studies, equity valuation, fixed income securities valuation, and option valuation. and people come from varied backgrounds. Some are already doing valuation, some are totally non-finance people also. So I've started everything from scratch, right from the beginning, and I have tried to cover as many case studies and fixed income and option questions as possible. And one more important thing I must tell you, probably I might have told you in one of the sessions, that at some of the NISM centers, MS Excel is not available because they don't have the license for it. In that case, they make you available Apache Open Office. And this Apache Open Office spreadsheet is very similar to Excel, but there are some difference. Like in Excel function, you put commas as separator, like equal to PV, bracket open, rate, comma, number of period, comma. But in Apache Open Office, you have to put semicolon sign instead of comma. That's the difference. So I will advise, once you book a slot, visit the center, ask to them, do they have Excel or what kind of software they will give you. If they are giving you free source software, download that software on your system and practice it at least for 15 minutes, 20 minutes, so that you don't get surprised when you reach the examination hall. So in this video, I have shown MS Excel, Apache Open Office, Libre Open Office, and if everything fails, then how to make calculation on calculator, ordinary calculator also I have shown. And definitely, being a recorded session, you can play this session at your own speed. One speed, 1.1, 1.2. If you're good enough, you can play it at 1.5 speed and you can save on your time. DIY style videos are this: do it yourself. I explain my question, then I say pause it, do it yourself on Excel, then again play it, and then I will show you the whole solution, and then you can match your answer. Because even if you're practicing MCQs, for example, and if you simultaneously look at the answers also, this is the question, this is the answer, question, answer. Until and unless you attempted yourself, sir, you won't have a grip. So just try to do this. These videos are not for free. The last thing, these are subscription based, and it's not like I'm making some huge money out of it or something. If you watch the video and after watching the video, if you feel like it's not worth, ask for 100% refund. You will be given it. For details, you can contact my office, and the number is written over here. I have also posted it in the chat box.